Hey there, awesome accounting student. Mark Franke here. This video is Accounting 101, Chapter 2. We're going to talk about debits and credits and rules of debits and credits. I'm going to use problem 2-2b as an illustration. So let's get started. First thing is we talk about how the accounting equation works, and these two words, you need to first get out of your head that debit is negative and credit is positive, or debit is positive and credit is negative, or any of that kind of thing. These are just two words. They're derived from Latin, and basically they mean left and right. Debit is left and credit is right. That's the way it works. So the main thing you have to remember is that assets go up with a debit. So in our box here, and I've given you a copy of this box in your working papers, and I would fill it out. In fact, I'll tell you, I had this box in my head when I sat and passed the CPA exam. And every day I would draw this box on a piece of scratch paper in the exam. That's not cheating. I didn't bring it in with me. I brought it in my head, and I would just to have it as a device to help me. It worked. So I've been using it ever since. Anyway, the point is, assets go up with a debit. Assets go up with a debit. If you say that to yourself 100 times today, you'll never forget it. And therefore, if they go up with a debit, they go down with a credit. Now, what are assets? These are things that have value that we own. Cash in a bank account, accounts receivable, supplies, equipment, furniture, computers, whatever it is, these are assets that have value and we own them. And they all go up with a debit. All assets work exactly the same. Now, the black line is the equal sign. And so we know when we jump over the equal sign, things flip over. They're the opposite. So now liabilities go up with a credit. Equity goes up with a credit. Always. Which means if they go up with a credit, they have to go down with a debit. So if you remember that assets go up with a debit, and if you say that 100 times, then the opposite is true of things that are on the right side of the equal sign, which is the credit side. Liabilities and equity or credits. Now, revenue makes equity go up. So revenue is always going to be a credit. And revenue doesn't really go down, at least not at this point in our accounting education. So I'm going to just kind of gray that out. And expenses. We know that expenses have a negative effect on equity, so expenses are always going to be debits. They go up with a debit, and expenses, like revenue, typically don't go down. They just go up. So we have 5 things, 5 fingers. Assets are debits, expenses are debits. Liabilities, equity, revenue are credits. If that helps you, great. Debits are assets and expenses. Liabilities, equity, and revenue are credits. Now, as far as equity is concerned, equity is capital. That's going to be a credit. And drawings are equity, and they're going to be a debit. Okay? So let's do a problem that we can illustrate. So you've got a journal. If not, set one up. This is what a journal looks like. Anytime in accounting we have a journal, it's going to look like this. This company is SoftWorks. This is all in your book. This is problem 2-2B. And let me put that in, and let me also put in my name, because if you watched my video on preparing work papers, you know I want your name and the problem at the top of every stinking page. And here is our journal. So if you want to take a sec, stop the video or pause the video and make a journal, or I gave you some work papers that you can just print out. This problem, problem 2-2B, I've got an extra little dash in there, that's fine, is on the bottom of page 77 in your textbook, and it goes on to page 78. This is a great problem. This is a problem that has all components in it. Now I've added financial statements to it, even though the problem doesn't call for that, but just to get practice in preparing financial statements. And we'll get to that. But anyway, the point is, it's in your book, 2-2B, page 77. And the first transaction says, Bernadette Grekus invested $65,000 cash, office equipment with a value of $57.50, $30,000 of computer equipment in the company exchange for common stock. So she issued common stock to herself for these assets. So we're going to label this A, and I like to label references in red. It makes it stand out a little bit. I'm not going to put the account number in yet, but we have a debit to cash, a debit to office equipment, and a debit to computer equipment. And then we're going to credit common stock. Okay, and cash is $65,000. Office equipment, $57.50. $30,000 is computer equipment, and the total is $100,750. And this is a description. Owner contributes assets in exchange for common stock, or something like that. So let's talk a little bit about the structure here. Debits are always first. We have 3 debits in this case and 1 credit. It's okay as long as it balances, and this does. Doesn't matter, but we always want the debits first. We want a description. Every single journal entry needs a description, period. Now, if we have a calculation, we put the calculation in. If we have the name of somebody, in this case we do have Bernadette's name, but whatever information we have, we put it in here. This is the journal. So if this, and the first accountant, Luca Pacioli, was a man, that's why this is called a journal. If this had been invented by a woman, it would be called a diary. It's a chronological record of stuff that happens in a business, the general journal. So it is what we call the book of original entry. These are transactions that are going to be memorialized or permanently recorded in this general journal, so that years from now, if somebody needs to know, they can go back. Okay? Now, got some T accounts. T accounts for each account. Again, you should have a work paper that looks like this. If you don't, you can pause the video and prepare one, but there's one in Canvas. So we've got cash and all the other accounts that are in our chart of accounts. So we're going to post these. And I'm going to start up here, and I'm posting cash, 65,000, and I'm putting the A next to it. That is a reference. Office equipment is also a debit. Debits are on the left, credits are on the right. Computer equipment is $30,000, and then we have common stock is the credit of $100,750. Again, this should be a review from Accounting 100 for you, so hopefully this isn't going to be a difficult concept. The only difference now is instead of using capital and the owner's name, we're using common stock because we're talking about a corporation. Transaction B, I'm going to go back to my journal and I'm going to scroll down to Transaction B. Transaction B says, the company purchased land worth $22,000, paying $5,000 in cash and signing a long-term note payable for $17,000. So we're going to debit land. Why we bought land. Oops, except I put in the credit column. For $22,000, we credit accounts payable for $17,000, and we credit cash for the down payment for $5,000. Doesn't really matter what order we put those credits in, but debits always come first. Purchased land for cash and a note payable, something like that. If we had the name of the bank that loaned us the money, we could do it. Put it in. Whatever information, every journal entry needs a description. And so we can go post this to our accounts as a debit to land. This is transaction B. A credit to cash for $5,000, transaction B, and a credit to accounts payable for $17,000, transaction B. All right, we'll do one more journal entry, and then I'm going to just post into the T accounts just to save time. This video will be 2 hours long, and I don't want that. So transaction C, which is the top of the next page, says the company purchased a portable building with $34,000 in cash and moved it onto the land acquired in B. So this is transaction C. We have now a debit to a building. That's an asset. And a credit to cash because we paid cash for the building and we spent $34,500. And now we can post these to our T accounts. Debit to the building. This is transaction C. $34,500 and a credit to cash. $34,500. Okay. So this is how it works. Oh, by the way, when we post, we should put the account number in to our journal. So cash is 101, office equipment is 163, computer equipment is 164, and common stock is 307. These were given to you in the book. Land is 172, accounts payable is 250, and cash is 101. And then buildings, we're going to use 170, and cash is still 101. So as you post these to your T accounts, when you prepare your journal, put the account number in there as you do this. So what I'm going to do now is read the transaction and just put them directly into the T accounts. And by the way, I know the book has general ledger. You can use T accounts anytime you want in lieu or instead of a general ledger. So I'm going to go through these very quickly and post them, and then we're going to balance it out. So transaction D, the company paid $5,000 cash For the premium on a 2-year insurance policy, we're going to debit prepaid insurance and credit cash. The company performs services for cash. This is transaction E. For $4,600, we're going to debit cash and credit fees earned for $4,600. We bought some, this is F, computer equipment. We paid $800 in cash and we signed a note for $3,700. The equipment cost us $4,500. Computer equipment. This is transaction F. $4,500 is the debit to computer equipment. We have a credit to cash for $800 and a credit to accounts payable for, notes payable. Actually, this is a note for $3,700. Transaction G, we perform some services for a client on account. Anytime you see perform services, you know we have revenue. And our revenue account is fees earned. That's a credit, $4,250. And we're going to debit accounts receivable. Because this client didn't pay us now, they're going to pay us later. Debit accounts receivable, $4,250, and credit fees earned. Transaction H, we bought some office equipment on account for $950. Debit office equipment, $950. This is H. And credit accounts payable, $950. Transaction H. I, we perform some services for a client on account. Same thing as G. This is going to be I. It is for $10,200. $10,200. Debit accounts receivable, $10,200. Credit fees earned, $10,200. J, we received a bill for computer rent. We didn't pay the bill, we just received the bill. So we're going to put this into accounts payable. So we're going to debit computer rental expense. This is J. We're going to put it in computer rental expense. This is transaction J, $580. And we're going to credit accounts payable for $580. This is transaction J. Transaction K, we received a partial payment from a client on account. Transaction K. So we're going to debit cash, $5,100, and we'll credit accounts receivable, $5,100. This is transaction K. Received money from a customer on account. Accounts receivable is going down. Cash is going up. Transaction L, we paid wages to the employee. So we're going to have wages expense for $1,800. Debit wages expense and credit cash, $1,800. Label it L. M, we paid a vendor on account. So transaction M is for $950. We paid that $950 off. Debit accounts payable, $950, and credit cash, $950. N, repairs expense. We paid for repairs expense with cash. We're going to debit repairs expense for $608. This is transaction N. And credit cash. because we spent the money. Cash is going down. Cash is an asset. Assets go down with a credit. We paid the dividends to the stockholder. Paid means cash is going down, and dividends are a negative equity account. This was $62.30. This is transaction debit dividends, $62.30. And credit cash, $62.30. We paid some more wages. This is transaction P. Wages expense was also $1,800. And credit cash, $1,800, transaction P. And then our last transaction, which is transaction Q, it says we paid advertising expense for the month. And this is a debit to advertising expense, $750, and credit cash, $750. All right, so I'm going to stop the video. I'm going to let me balance out the cash account first, just so you can see. I know you probably know how to do this, but we'll just do it also. So what I'm going to do is I'm going to draw a line and then I'm going to put EB for ending balance, and I'm going to add all the debits and subtract all the credits. $17,262, and I will shade it in yellow so that it's highlighted. That's the balance in the cash account at the end of the transactions, the end of the month. Okay, so stop the video or pause it and then balance out all the accounts, and I'll be right back with the answers. Stay tuned. Okay, so through the magic of video, here are the ending balances in the accounts. And if we take these balances and we put them into the trial balance, we should get something that looks like this. Let me make it a little smaller. We're just listing out each account in our chart of accounts that has a balance and totaling it up. If you want to stop the video and balance out your stuff and make sure it all works, and I've got April of 19. I'm going to change that to April of 2020 just for grins. And then, and I'm not going to go through preparing the financial statements step by step. Again, I hope in Accounting 100 you had the opportunity to do that many times. But I do want to give you a picture that you can use for practice purposes. But I don't want this video to be too much longer. So anyway, if we put the financial statements together, they will look like this. And again, I'm going to change this to be 20 and 20. But I want to point out a couple of things that are important on preparing financial statements. First of all, we have to do them in this order. They have to be income statement first, Then a statement of retained earnings. That's a corporation thing. We used to use a statement of a statement of owner's equity in a sole proprietorship back in Accounting 100. We are now in a corporation situation environment. So we use the statement of retained earnings, where we're taking retained earnings at the beginning, which in this case was 0 because this is the first month of operations. Then we had net income from above, $13,512. We're subtracting the dividends, $62.30, and ending retained earnings is $72.82. The income statement and the statement of retained earnings cover a period of time. The balance sheet is a picture as a moment in time. At midnight on April 30th, here's the balances. So, $ top and bottom on the income statement with railroad tracks, double lines. $ top and bottom on the retained earnings statement with railroad tracks. Railroad tracks means we're done. This is it. We're done. We're stopping. And then on the balance sheet, we have actually 2 sets of $. $ top and bottom in assets with railroad tracks. $ top and bottom for liabilities and equity. Of course, the retained earnings balance comes over from the retained earnings statement, and the assets has to equal liabilities and stockholders' equity. So now you have an example for problem 2-2b, which you could practice over and over again if you'd like. But if nothing else, you can use this for practicing problem 2-2a, which I have assigned for practice. That's it for now on this one. Thanks for listening, and I'll see you again real soon.